Talk about it all in our closing bell exchange today. Uri Landesman is with us today from Platinum Partners. Paul Dietrich from Fairfax Global Markets. Jeff Cox from CNBC.com. Meg Green, who coincidentally works for Meg Green and Associates. And, of course, our own Rick Santelli joins us as well today. Yeah, how about that? Hey, Uri, what do you think of this market right now? You think that we're going to see a correction, maybe as much as a 300-point decline in the S&P between now and September. Why?
Well, a number of reasons. This market has basically been a straight rocket shot for almost 5.5 years right now. And so I think there needs to be some regression to the mean. I think the market is priced for perfection here. Any bad news, I think, could rattle people. I think you could see just a normal kind of correction of about 150 points. And I think that will panic people into selling off an additional 150 points.
Well, I mean, yeah, if you're talking S&P points, it'd be significantly more than that on the Dow. Or have you been positioning for a sell-off, though? Haven't you for a while been expecting a correction?
Yeah, so we run essentially a market-neutral fund, so we aren't really taking long-short bets versus the market. I have been looking for this correction for a while. It's been a very, very strong market because of the Fed, because of acquisitions, and because of the lack of alternatives. But I think that those will cease to carry the day, and that the factors I cited beforehand will eventually spook this market in the next couple of months.
Meg, for you, it's about inflation. We got to keep an eye out, what, on oil, on gold, on those things that the Fed seems to be okay with right now, yes?
Well, you know, the CPI index doesn't have food and it doesn't have energy in it. The two things that we're all feeling inflation-wise is food and energy. But you can't have the Fed keep interest rates higher because of a drought. That's not going to work, or because of what's going on in the Middle East. So we're having inflation. It's just that the numbers aren't showing that. And as far as I'm concerned, I do not see a big correction. I see a lot of confidence, a lot of people. Look, the VIX is way down. I mean, the last time it was at its low, which is before 1997, we had 3 years continuing of a bull market. I think a lot of traders are in the Hamptons. I think people are comfortable. I think there's a lot of cash on the sides, not only in investors, but in corporations.
That sounds complacent to me.
Where is this correction? If we didn't have a big scare in the Middle East, which scares me actually, not out of the market, though, where are we going?
Is this complacency, though?
I think some of it is complacency. I think it's a wait and see. I think there are a lot of people from, 5 years ago that are still on the sidelines. But if you take a look at what's happening in Europe right now, I mean, $500 billion worth of stimulus. It costs banks 0.1. It costs them to keep money in banks overnight. What's going on here? I mean, we're not in a highly inflationary environment, except the inflation that we're all feeling, and that again is disruption and droughts. It's not the CPI, and it's not that PCE, which is what the Fed uses, personal consumer expenditure.
Yeah, Paul, I see here that you're also, looking for a pullback here, thinking a 10-15% correction would be healthy. But I just want to go back to the data we got this morning, kind of to Meg's point, which is the flash PMI, the manufacturing gauge for the U.S. rose by a couple of points to 57.5, and the existing home sales report was a pretty solid beat.
Yeah, I think you have to make a distinction between the stock market and the underlying economy. The underlying economy is doing just fine. It's expanding and it's growing. But as Uri said, this market is overvalued. It was up, the Dow was up 26% plus last year. And we are going to see a correction of 10 or 15%. We're value investors at Fairfax Global Markets, and I do a screen every week where I'm looking for low PE stocks, high return on equity stocks, high free cash flow stocks, and little or no debt. A year ago, I was finding 100, 150 stocks I could buy. Last Friday, I could only find 13. What that's saying is that there are no undervalued stocks in this market. And whenever that has happened in the past, we've always seen some correction. And I think the correction will be very healthy to have a 10 or 15% correction. We'll go back to mean and we'll start back up. And I actually think that after the elections, we're going to see, 10, 15% gains on the markets from the beginning of the year.
But Jeff Cox, you have the rise in gold, you have the situation in Iraq, you have oil going higher, you have, all these potential disruptors, and yet the market just continues to meander on here.
Yeah, well, here's the great equalizer, Bill, something I reported on today. First quarter this year, companies bought back $160 billion worth of their own shares. That's a 60% increase. It's the second highest quarter ever. Now, I think a lot of folks thought that going into this year, we'd start to see maybe a little unwinding of this trend where companies devoted so much cash and so much borrowed money to share repurchases and share reductions, but we're not seeing that. So who's that good news for? It's good news for people in the equity market. I mean, you could say maybe we pushed on a string a little bit, but it puts some type of floor under the market. Who's it not such good news for? It's not such good news for people who thought that maybe companies would put that money towards hiring, towards R&D, towards the type of things that grow an economy organically rather than just try to push asset prices higher.
Rick Santelli, get in here, sir, if you would. What do you see in your dashboard today? I mean, as we almost close the second quarter, which looks like it's going to be another winning quarter for the market, what about the rates outlook? What about some of the moves in Forex that we're seeing?
Well, first of all, to build on Jeff Cox's comments, he's absolutely correct, of course, on the buybacks. But as the Wall Street Journal pointed out 5 days ago, add in dividends, and the first quarter number shoots up to $241.2 billion, usurping, that's a record, usurping the previous record, which I can't say enough. Fourth quarter of 07. Remember, fourth quarter of 07 was like looking over a cliff when you think of 08. As far as, let's look at existing home sales today. We put up a chart. It was the best number since October, which means it's 400,000 handles in a row. October was a 500,000 handle, and we had 6 of those in a row. So as the chart clearly shows, we may be on top of the market with regard to equities. We're not with many metrics regarding housing or the general economy. So our 2 guests ago is correct. There's a difference between the level of stocks and the economy. And as far as interest rates go, yes, we moved up a bit late in the session. Since the Fed meeting, this looks like it's going to be the third close between 260 and 262. And if you look at European bond yields in particular, very close to 130. As you see on the chart, we continue to see lots of pressure with low European rates, which will, for all practical purposes, put a lid on ours as well.
Rick, if the economy, like you're saying, isn't as strong as to be believed from some of these headlines, does that mean this rally, supported by the buybacks and all of that that's been discussed, can keep going apace here for equities?
My new theory is that we're not going to get any major corrections. We're going to die on the vine at very lofty levels with no volatility and very little volume for many traders.
Where are you going anyway?
That's what the VIX seemed to be suggesting. Uri Landesman, what would be the spark in your view? What would cause the kind of correction you would expect between now and September, do you think?
It's hard to say. Certainly the geopolitical situation in the Middle East is something that could be an issue, especially
We've had a crisis in Ukraine. We've got a crisis in Iraq. I mean, there's crisis everywhere, and it's
Don't
still
forget
not
Syria.
Syria as well. Still.
Right. But there hasn't been significant oil production taken off yet from any of these. If
Tell
that would
to the
happen,
oil
that could be a
I
market.
just,
well,
I wrote in late January that I think headline risk, I think that I agree totally with Rick that the notion of a correction, I don't think we're going to get one. I think headline risk is basically out of the market for this year. And I think, we just keep pushing I hate to use the cliche, but kicking the can down the road. And the big thing is going to be when interest rates come up. When is that going to be? It's anybody's guess. I can tell you, folks I'm talking to weren't happy with Janet Yellen's comments last week about the noisy inflation data. And if there's anything that could bring this market down, it's the Fed being behind the curve.
Yeah, Paul, just last thing before we wrap this up, what were just a couple of those names where you did see value on Friday?
One of the 13.
I see agriculture as a long-term trend upwards, mainly because we're just having quarter after quarter export growth, mainly to Asia. And I think this is a long-term trend that will continue. And I think the best way to play it is through the Power Shares DB Agriculture, Sanderson Farms, and Pilgrim's Pride, both of those companies have very low PEs, very high return on equity, very high cash flow, and these are companies to watch, and I believe that whole sector is going to grow for a long time.
All right, and it tastes like chicken. That's it.
Thanks for now, guys.
Thank you all, guys, for your thoughts.
All we need is water.
There you go.
Well,
just add water.